Rick Frayn writes that 1720 was the first international crisis. Bubbles popped in London, Paris, and Amsterdam. The Mississippi and the South Sea bubbles were connected. Many British speculated in Paris, and many continentals speculated in London. Many speculators lost a lot, if not everything, as both bubbles popped in 1720. What can individual investors learn today to avoid a similar fate? We'll start our account of the South Sea bubble with its context, England in the late 1600s. Economic historian Andreades wrote that wars often forced the English king to borrow. But the king was above the law. No subjects could go to court to protect their property. In 1672, King Charles II defaulted in the infamous Stop of Exchequer. Parliament realized that royal defaults were a danger, and approved taxes only for the current year. Given limited tax income, King William III had to look for other sources of funds, and thus approved a plan to create the Bank of England in 1694. Financing through the bank made the disbursement of state funds transparent. The English king would no longer be able to evade Parliament's supervision. The newly created Bank of England thus acted as a commitment device, making the king's promise to pay back state debts credible. As seen here earlier, the story of the world's first central bank in Sweden, 1668, can be summarized as an institution that prevents kings from expropriating their people. The same can be said of the Bank of England. According to John Carswell, the Chancellor of the Exchequer devised in 1711 a plan to consolidate £9 million of state debt. The plan was similar to how the Bank of England had been created. State debt holders would swap bonds for equity in a new company. The South Sea Company would pay 6% dividends, and it was also granted a monopoly to trade with South America. The War of the Spanish Succession then ended with the Treaty of Utrecht, improving prospects for the new company. As seen here earlier, Scottish fugitive John Law copied this idea to convince the French king to create his own monopoly trading company in 1717. But, as noted by scholar Peter Garber, the financial operations of the British scheme were much simpler than the French. The South Sea Company was not involved in large-scale takeovers of commercial companies, nor in government functions such as the mint, the collection of taxes, or the creation of paper money. Peter Garber continues, by 1720, South Sea Company assets were its holdings of state debt and the monopoly rights on South Seas trade. But British trade was blocked by Spain. So the English copied John Law and swapped even more state debt for equity. Parliament passed a bill allowing the South Sea Company to acquire £31 million of state debt, financed of course by issuing new stock. The interest paid by the state fell to 5% until 1727, in a large reduction of debt servicing costs. The South Sea Company beat the Bank of England in the competitive bid to win the 1720 deal. How did they do it? According to Scott, the South Sea Company paid bribes to members of Parliament and favourites of the king totalling £1.3 million. But there was more. The South Sea Company favoured members of Parliament in its stock subscriptions. And most MPs received large cash loans from the company on their shares. The total par value of shares acquired by MPs was £1.1 million. In a recent exhibit at Harvard's Baker Library, you could have seen for yourself how London's then vibrant print media got involved with South Sea. Famous writers such as Daniel Defoe and Jonathan Swift were hired to tout South Sea. Historian R. Bialuszewski notes that it was very important to South Sea officers to generate favorable public opinion, as the success of the company depended on the confidence of investors. Here's an example, a pamphlet entitled, A True Account. Really? It happened very fast. In January, South Sea stock traded at £120. As Parliament passed the Act on March 21, stock prices jumped to £300. To finance the contracted bribes and loans, the company issued new shares twice in April. The first required a down payment of only 1/5 of face value, and the second was even more leveraged. Only 1/10 of margin required. Speculators went wild. Stock prices exploded. 2 more stock issues followed. By late July, South Sea stock approached 1,000. South Sea speculation triggered a boom in stock prices of other companies in London. Some of these were fraudulent, but not all. Several insurance companies were legitimate. Although this bubble was later named after the South Sea Company, other companies bubbled even more. The stock of two marine insurance companies, Royal Exchange Assurance and London Assurance, rose to much higher levels. Should we rename this crash as the marine insurance bubble? The success of other companies alarmed South Sea officers. They had paid to buy Parliament, and would not allow others to compete with South Sea. Thus, Parliament passed the Bubble Act in June, banning unauthorized companies. Ironically, as the act was enforced against South Sea competitors in August, the bubble peaked. Since stock was held on margin, heavy selling hit all stocks, including South Sea's, in a scramble for liquidity. By late 1720, South Sea ended where it started, £120. Garber writes that the Mississippi and South Sea bubbles were remarkably similar. Each involved a company that sought a rapid expansion of its balance sheet through corporate takeovers or acquisition of government debt, financed by successive issues of shares. The new waves of shares marketed were offered at successively higher prices. The purchasers of the last wave of shares took the greatest losses when stock prices fell, while the initial buyers generally profited. Curiously, the South Sea bubble, the Mississippi bubble, and the Dutch bubble all popped within months. Not a coincidence, according to Garber, who notes that other scholars before him described the international scramble for liquidity as speculators on margin sold stock in London, Paris and Amsterdam at the same time. Freyen agrees. The patterns of stock run-ups in Amsterdam and London suggest a high degree of integration between these markets. And then, the international contagion spread. The then Republic of Bern was exposed to the bubbles in both Paris and London. As the bubbles popped, a banking crisis in Bern followed. Two banks in Bern turned insolvent and had to be liquidated. The banks were Malacrida and Samuel Muller, according to Nicolaus Linder. After the bubble popped, Parliament turned against the company, forcing it to sell off part of its debt to the Bank of England. Parliament then stripped the directors of the company and several government officials of their wealth, £2 million then. As the bubble popped, the Chancellor of the Exchequer was John Aislabie. Parliament found that he had been given £20,000 of company stock in exchange for his promotion of the scheme. He resigned the Exchequer in 1721, and found guilty of the most notorious, dangerous and infamous corruption. He was then expelled from the House of Commons and imprisoned in the Tower of London. Ta-da! Our verified sources are listed here. We encourage you to tell us if your interpretation is different, or if you'd like to suggest other verified sources. What do these tell us altogether? Scholars agree that this was history's first international crisis. Bubbles popped in London, Paris, and Amsterdam at the same time. But scholars disagree on the company's fundamentals. Some scholars claim that the company's prospects were strong after the Treaty of Utrecht, and that the bribing of MPs signaled that the rich and powerful expected the company to succeed. But our takeaways from this bubble have little to do with rationality. Our takeaways for South Sea are the same for Mississippi's. First, the Minsky model, which also fits well with South Sea, encourages us to be wary of spectacular price jumps. Next, avoid leverage. Financial bubbles are like fire in crowded theaters. Once someone yells fire, everyone will rush to the same door, and many will get hurt. Institutional investors get caught in bubbles too, as we saw two Swiss banks blowing up here. Finally, never speculate with cash you cannot afford to lose. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.